Hello again, Mark from Landmark Financial Services Group. It is still a dreary day, as you can see outside, but we're still sunshiny here in the office. This month we're talking about deductions that are available to individuals. And on the last video we talked about medical expenses, and today we're going to talk about the other three. There is taxes that you pay, there's interest on mortgages, and there's charitable donations. So let's cover those really quickly. The first one is taxes. Now, any tax that you pay to a municipality, it could be real estate tax, it could be excise taxes on your car, it could be state income taxes you pay to the state of Massachusetts. You can add all of those taxes up. And here's the kicker. The new tax law says after you've added all of them up, if it's above $10,000, all you get to deduct is $10,000. If you have $22,000 of real estate excise and state income tax, you only get 10. That's it. Okay? So we're often finding, especially here in Massachusetts and our bordering state of New Hampshire, the high real estate tax or the state income tax often puts many of our folks over that amount. So you're right, probably going to be deducting the $10,000. The second is interest. Now, this is interest on your mortgage. Again, there was new tax law that took effect in 18. Prior to 18, you could deduct the interest on the mortgage associated with a primary residence and one other residence, and you could have mortgage principal up to $1.1 million. Today, that's not the case. Okay? Today, you can deduct mortgage principal. If you start a new mortgage, you can only deduct interest on $750,000 of principal. Now, there was an old strategy that people used to do, which was they would take money out of a refinance, maybe 20 grand extra, and they would use that money to pay off a credit card. And that interest used to be deductible associated with that extra 20 grand. That's no longer the case. Okay, so only the mortgage, only the loan rather, associated with buying, building, or improving your home makes it deductible. Okay, so that's unlimited in terms of the interest that you can deduct, but the limitation is how much principal is associated with it. Lastly, there's charitable donations. Charitable donations are still deductible. You always want to get a receipt. So what is a receipt? If it's under $250 of a donation, a canceled check, a credit card receipt, all will apply to the documentation requirements for being able to deduct a charitable donation. If it's more than $250, you need to get something from the charity, a letter that says, thank you, Mr. and Mrs. Jones, for making a contribution of $500. No gifts or nothing was returned of value to you in making this gift. And that letter has to be in your possession when we go to file your return. And again, back to what we said in the very first video is when is it deductible? Again, when you charge it on your credit card or the date you wrote the check and delivered it to the charity, that's the date at which it becomes deductible. So those are three other deductions that we see. It's the taxes, which limits at $10,000. There's interest on your mortgage, which if it's a new mortgage, can only be on principal up to $750,000. And then there's charitable donations. And again, you can make cash donations. And the one thing I didn't say was non-cash. And we do see that often where people are making donations to the Salvation Army, and it could be clothing or furniture or other household items. That also is a very popular way to drive up a deduction. So if you have any questions about any of these deductions, please give us a call, 978-984-5425. You can look us up on the web at lmfsg.com. Thanks.